Hello and welcome to the AiCR Exchange. I'm Joe Furlong, and I have with me today an old colleague of mine by the name of Dean Hurley. He runs MIAC's whole loan group, which handles residential, commercial, consumer whole loans and structures and risk retention, a lot. And today we're going to have a great conversation about what he does, how he feels the market's going to go, and all of the things. So, Dean, thank you for joining me today.
Glad to be here, Joe.
Awesome. So let's start off the conversation. Let's talk about your ultimately your valuation approach at a high level. What do you do? How does it work? Can you just give me a great overview on what you do with, just say, hold ons for right now?
Okay. The process has two distinct levels. The highest level is what I would call the SOC 1 level. We have a series of steps that we follow for every valuation. And the process looks like this. We have a client, we receive a data tape. We send a SOC 1 email acknowledging that we received the data tape. We take that data tape, we load it into our ETL software, Data Raptor, for data review and normalization, error checking. We send an email to the client along with reports called source and strat reports and data exception reports. If the client responds affirmatively and confirms our totals, he saved us a world of trouble. We won't have run a valuation on the wrong data tape inadvertently, and we have basic buy-in that what's been provided is accurate. Now we go ahead and we load that information into our Vision software. Vision is the cash flow generating software, and we run a valuation, we tune it, and at that point, it now goes from the analyst who runs it to a supervisor, or in some cases, that person may be me. We review the valuation, make certain it makes sense.
Sure. So, Dean, clearly your process is quite robust, validating and making sure it's all right. Clearly, the data is a big part of the process. And I always thought that some of our clients historically kind of overlook the need of good quality data. I mean, I'm assuming a big part of your process is trying to make sure that the data that you're using in your process is clean and as accurate as possible. Is that a fair statement?
Very fair. It's one of our biggest headaches, particularly some of our largest clients. And when you're talking about wholesale lenders, and that might be a bank or an investment bank or a quasi-government entity that takes loans in pledge and makes loans to the people that originated the loans, those people often get very messy data, and they don't necessarily get the same formats from all their clients. We receive the data, and we spend a lot of time doing data scrubbing and cleanup and normalization to do the very best we can to make certain that the data is accurate, correct, and properly normalized.
That's great. I mean, and I'm assuming during that during that process, you make your assumptions, you apply it, because clearly it's almost the old adage, garbage in, garbage out. And so does that actually, once you go through that process, you apply the appropriate assumptions you need, and it goes into your cash flow forecast? Can you tell us a little bit,
yes,
in essence, about how that part of the equation works?
Well, it sounds like you asked two questions. So the first question is, when we send source and strat reports, we also send data exception reports, and we may send them an email or ask to do a call and say, look, we have to make some assumptions here. You do not have accurate data, or we have concerns about the data, or there's missing data. And we tell them, here's what we are missing. Here's what we can assume. Do you have a different idea about this? We don't get to the step where they confirm if they're not telling us what to do about erroneous data. So that's the first question. The
Okay.
second question seemed to be, well, what happens once you've made all the assumptions? The analyst is going to go into Data Raptor, make certain that the project has the necessary assumptions. Data Raptor feeds the database that Vision picks up to run cash flows. Vision is a cash flow forecasting tool that takes as inputs assumptions about voluntary prepayments, defaults, severities, recovery timing, yields, primarily those assumptions. And Vision does have some proprietary tools that allow us to estimate those things with great accuracy, particularly in the residential area where we have the conditional response model. We call it CORE for short, CORE. And that model is based on very large databases that were run through our borrower analytics team. They used logistic regression techniques to create vectors payment cash flow, generally the widest accepted valuation technique. So again, at a high level, that's where we're coming out. That's how Vision looks.
So I assume within your cash flow projections, you have all these different elements of the cash flow to come up with which was the net cash flow, which includes loss and prepayments and defaults and the timing of those loss recoveries and all those things to be able to drive the ultimate net cash flow, right?
That is absolutely correct. And that net cash flow is then discounted. We use bond equivalent yields because we're typically valuing using spreads over treasuries or spreads over swaps or spreads over TBAs to benchmark and value each individual loan. We go through that process at the loan level, generating cash flows for each loan and applying a yield to each cash flow. That yield is converted from bond equivalent to a mortgage equivalent yield, and we produce a discounted cash flow number. That's the price.
So let's
That's
talk about
what's called a clean price.
let's talk about the yields and the spreads. Obviously, you hear in the news quite a bit about various spreads and different yields, whether it be the 3-month and the 10-year, and there's a lot in the news about that. I mean, so how do you go about determining the spreads in what you use by the product type? How's that process look?
Well, we have several steps or legs in that process. The first leg is that we have a rate model in our system that gives us daily interest rates for swaps, for treasuries, for TBAs, for SONIA if you're doing something in London, or for European Union numbers. You can see gilts in the system. We calculate the average life, which is a standard practice in the banking and investment banking worlds. And that average life is then used to interpolate what the appropriate benchmark, be it a treasury or a swap or whatever. Then we use information that we have from a variety of external sources to determine spreads. We have spreads on new originations that are coming from rate sheets. We have the surveys on commercial from Cushman and Wakefield. We see product coming out of a number of clients. We are actively engaged in valuing product for a number of insurance company-owned hedge funds. And these funds need investor letters basically saying that we agree that the prices that were paid when these packages were bought from originators are at market levels. To do that, we have to have access to information from them about their assumptions. And those assumptions include cumulative defaults, the loss severity, the average life, the voluntary prepayment level, and the yield. If we know the valuation date, we can back out their spreads, and we are doing that every day on packages that we're valuing for these clients. So now we have triangulation. We have information from rate sheets, we have information from clients, we have information from third-party sources like Cushman and Wakefield. We compare that information to see how accurate it is to determine our spreads. For other types of products, we also have return on equity based models that will allow us to determine the spread over the benchmark. So there are multiple ways that we can arrive at the yields that are used. And believing the same question on their side, what's the value of this? Is MIAC accurate?
So let's talk about that. We're going to get into that right now. So before I go into the actual valuations and the drivers of those valuations, obviously over the last year or 18 months, rates have been dropping. Obviously, if you use residential mortgage rates as an example, a year ago they're in their sevens and now they're in the low sixes. Are yields also dropping in a similar kind of direction, or are they not following the normal trajectory?
We have seen rates have not always gone down. In some cases, they've gone up. We've seen the yield curve steepening from an inverted yield curve to a normally shaped yield curve to a steeper yield curve. So what's happening is for some product, like residential mortgages at longer rates, longer terms, you look at 30-year residential mortgages, the mortgage rates have actually gone up as the yield curve is steepened, even as short rates have gone down as the Fed has reduced their target Fed funds rates. So we also are seeing a decrease in spreads, and as things catch up, you're generally seeing a downward trend in rates, but not always. And that's what it looks like high level since last summer.
Got it. So I know that the attributes associated with the specific loans or the pool of loans that you're valuing drives the ultimate determination of its value, the losses, and that sort of thing. Mm-hmm. Can you talk about the few items or attributes that really are the main contributing elements of how that loan is valued or the losses associated with it?
In residential mortgage land, it's going to be the loan size, the loan term, whether it's an IO or a partial amortizer, whether it's fixed or floating. Then you look at key credit metrics like FICO score, loan to value or combined loan to value if it's a second, debt to income ratio. When you move over into the commercial space, the most common metric is the debt service coverage ratio, which is basically DTI flipped on its head. It's looking at the total amount of expenses and the debt payment versus the available income. So those are the key drivers. They're not the only drivers. Some residential mortgage product varies based upon the documentation type, the occupancy code, whether or not it's a foreign borrower. I think that's a pretty good list for a quick discussion.
That's great. So trying to be is keeping all things equal. Have you seen the average valuation for, let's take residential home homes as an example, everything remaining equal, has that price been pretty stable over the last year or two? Is it going up? Is it going down? Do you have any insight that you can give on how things are looking?
There's been, on new originations particularly, there has been upward pressure in the non-QM space. That market is hot right now. Very much the same for closed-end seconds. There's a lot of demand for that product. New originations are bid competitively, and we have seen decreasing spreads, and in general that means a higher price. Now, there is a point at which buyers won't pay more for different product, and they don't officially cap. We've had that discussion with several of our clients. Do you cap prices? They say, well, we've talked about that, but we're not actually doing it. And by the way, Dean, we don't see this product generally go much beyond 104. we're not really seeing 105 prices on this, but then for other products, we're seeing 106 prices on some on closed-end seconds. We're seeing these prices. They're basically saying what amount of the yield or the coupon on that product they expect to get. They look at you and say, if your price is beyond what they consider reasonable, Dean, you're not factoring in enough prepayments, or you're not factoring in enough defaults, because that loan is either going to prepay or default before you can earn back that premium. So that's what the market looks like, and we've seen those numbers slip upward over the last 3 to 4 years, from levels in the 103 and 104 range to levels in the 106 range in terms of where people simply won't pay anymore.
That's pretty significant. A 103 to a 106 is a heck of a rise, wouldn't you say?
Yes, it's a hot market. There's absolutely no question about it. The demand for product exceeds supply, and prices are elevated. Now, when the yield curve shifted, we saw certain packages that have been trading in the low 104s or high 103s suddenly drop back into the 102s, the mid 102s. So you do see variance in this over time as the market shifts, as the yield curve shifts, but the general trend has been towards higher prices and higher effective premiums that buyers are willing to pay to obtain product.
So that you entered it exactly where I wanted to go. So clearly people think modeling is all science, it's all math. It really isn't. There's a combination of art and science, because you have to be able to factor in qualitative demand. If you mark the model, which of case sometimes you do it, but that may not represent the true market value. Am I saying that correctly, Dean? Can you help us understand?
That's a good way to say it. When I first started out in this business back in like 1988, I got a lot of pressure. Dean, we're not winning portfolios. Why aren't we winning portfolios? And I would look at them and I'd say, well, I've got the servicing assumption from our servicing shop. I've got our borrowing costs from our treasury department. I've got default and prepayment and severity assumptions from our loan team, our originators. What am I doing wrong? And they said, we're losing portfolios. We're not getting anything. I reduced the prepayment speed. Price went up. Suddenly, we're hitting the bid. I get pulled into the president's office. How much money did we leave on the table, Dean? And I'm like, I can follow up and see if I can get anything about cover bids, but frankly, I'm not sure. So it is very much a psychological game that the buyers and the sellers play. You can model it mathematically. That doesn't mean you're going to get the market price.
Understood.
And that's a point that I make with my bosses when they tell me how objective truth comes out of our core models. And I tell them that's great and it's an important guideline, but if they tell me that their assumptions are different, I'm going to move to the market assumptions so that we get market prices.
All that makes perfect sense. And obviously we're here to transact business. Our clients are here to transact business. If our models are not reflecting the market pricing, we need to make the assumptions to be able to do business. I mean, that's just the way it is. Now, I know some of our clients may not be asking you to do valuation work for a transaction, rather something to mark on their books, or whether it be losses or whatever the case may be. And let's kind of focus on one particular area that every year you hear a lot in the news is stress testing.
Yep.
Tell us about what stress testing is and how does it differ from the normal process that you do?
Stress testing is a process where you run macro factor scenarios through the models. All of our models will take macro factors, whether they're core models or commercial models or consumer models. The models will take unemployment, HPI, inflation, GDP, and produce output from the credit models and the yield models that allow us to determine what the value of the portfolio will be under various scenarios. We can take the credit scenarios coming out of the OCC and the Fed, which are the official, what would be called DFAST scenarios, and we can get a vector out of core that moves up and down, increasing in the scenario. So you're moving both credit and yield assumptions as part of that process. An analogous type of valuation work doesn't produce a price. It produces credit losses. It's called CECL, or current expected credit loss. And we will run macro factor scenarios. We will run the basic three that come, or if a client has different macro factor scenarios that they want run, we will run those. And again, it gets fed into core, it gets fed into vision, and we can produce higher or lower credit losses depending upon those scenarios, and then report them out to show 3 scenarios worth of credit losses and how those move across the portfolio that's being valued. Or for DFAST purposes, we can show them both the credit and the final price changes in the portfolio. That's what it looks like. Again, at a high level, but with enough detail that you can understand how we're accomplishing that.
Thank you. So let me ask you to put on your magic hat or read into your crystal ball. How do you see the market going forward, whether it be the next 6 months, 12 months, or whatever? Do you feel it's going to improve? Do you think those prices of 106 are going to stay up there? What is your best estimation, Dean?
We live in a world where there are black swans. I can't tell you that there won't be one. Some major event like the Middle East blows up, no oil comes out of Saudi Arabia. We're trying desperately to get oil out of Venezuela, and markets crash. If that happens, all bets are off. But in the current environment, what we can see is a situation where our government has been increasing stimulus by basically lowering taxes and attempting to lower interest rates in a measured way. That's going to ripple through the economy and be weighed against the increase in tariffs that we see. So next year you'll see a growth rate that's not as high as the 4.3% growth rate that we saw in 2025. You'll have a good growth rate in the 3% range in 2026, and that may drop back to 1.8 to 2% in 2027. You will see interest rates come down. Right now, the markets are betting on 2 rate decreases starting in the summer, and then a second one in the fall. So you're not going to see interest rates come down really fast. You're going to see them continue to come down slow. That means that mortgage rates will decline as long as the yield curve doesn't get any steeper. We think the yield curve is about where it should be right now. So broad strokes, we're looking at 2 more years of positive growth, but declining levels of positive growth. That's going to translate to increased residential mortgage origination in the next 2 years. So that number will climb in 26 and 27 if that forecast holds true.
Well, that's great. That's really great to hear. Well, Dean, I can't thank you enough for taking time out of your day today to have this great conversation about everything you're doing. I definitely learned a lot from what you had to share, and I really am grateful. Of course, everyone that's listening, please take a minute, like and follow my LinkedIn page, the AiCR LinkedIn page, as well as Dean and MIAC's LinkedIn page. If anyone wants to reach out to me, LinkedIn's the best way to go. Dean, I'm assuming everyone can find you on LinkedIn or the normal ways to be able to reach out to you.
Look up Dean Hurley and MIAC. You should be able to pull me right up.
Beautiful, beautiful. Well, Dean, thank you again for your time, and everyone that took their time to watch the show. Really enjoy it, and until next time, thanks.